Hi, everyone, and welcome to the Buffett and Beyond Research Saturday Market Recap for June 29th, 2024. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And, well, this week the market, it wants to go down, but it is in a bullish end of the month time period. Then there's a holiday this coming week, which is very bullish, but signals are beginning to point down, and Friday turned down, and that means when Friday is a down day, it means that people do not have confidence over the weekend that something won't happen to send the market down further. No clue what that could be, but that's how the market works pretty much all the time. And yes, this is going to be a typical bull versus bear market battle setting up for this week, folks. Now, for our weekly stock analysis video, Nike reported earnings this week, and the big question looms, is the air coming out of Air Nike? Well, the growth in earnings is certainly slowing down. That's decelerating, folks, not very good. And adding to that, retail is about as sluggish as a bucket of tar in the winter. And that means almost hard as a rock, and it's not going anywhere for now anyway. And our ETF video, well, our favorite ETF portfolios are doing great for the individual stocks that we've picked out of those ETFs, but we see some big cracks in their performance. And as long as new home sales continue worsening, we cannot expect the rest of the economy to perform very well at all. I mean, remember, home building affects almost all corners of our economy. And when we look at the S&P 500, here we are. We've been looking for a reversion to the mean, which in this case is the 20-day moving average, which is this middle line right in here. And for you newcomers, the top band and the bottom band, these red lines are volatility bands. And if you really want to know, they are 2 standard deviations away from this center line. So 95%, actually 98% of the market is contained within these 2 bands. So we've had a market that has done nothing over the past 2 weeks, and we kept talking about the reversion to the mean, and we were looking for a correction down to the 20-day moving average at least. And it looks like we're starting to get that, because Friday the market was chugging along slightly negative, and then right at the end sold off. And I just mentioned that the people trading the market are not confident about holding their positions over the weekend. And down here we can see this blue line slightly crossing the red line, which is giving us a slight sell signal, which means the market's getting weaker as we go along. Now, when we look at the S&P 500 on the candlesticks, we can see this big decline on Friday. And this green line is the 20-day moving average. This blue line is a 50-day moving average. And we can see down here these vertical red lines represent the volume on the down days. So when the market closes down, this is the volume, and you can see the red lines are much, much stronger than the green lines. The green lines represent the market volume when the market closes up for the day, and here we see that the red lines are totally dominating the green lines, and we can see that crossover right here of the black line over the red line in this case. And we use this as our primary intermediate term indicator. It's pretty much a trend following indicator, and it follows the prices, and it tells us whether the prices are going down or whether the prices are going up. And right now things are not looking too good for the markets here, even though we have a holiday coming up this week. When we look at the QQQs, the strongest of all the indices that we follow, and we see this big double top up here. Yeah, the market on Friday tried to get to this new high in here, but just couldn't do it. And when it couldn't do it, it fell and closed down near the bottom of the day. Again, green line is that 20-day moving average. These red vertical lines down here show the down volume higher than the up volume on those down days, and we definitely see a crossover of the black line over the red line, indicating a weakening market. And when we look at the Dow Industrials, this is the only one that shows some promise, but It came down and tested the 20-day moving average, again, this green line right in here, and it fell below it but came back and closed above it. So that gave us a little hope in here, but when we come down to the volume again, nope, this volume on the down day was pretty heavy. Now, we had volume on an up day during the week, and that's when people thought all of a sudden they were going to sell off their tech stocks. This was lasted a couple of days, maybe two, and just one with heavy volume. They decided to sell off their tech stocks and buy some of the Dow Industrials, and that lasted a whole day. So we're looking at this red volume right in here for Friday's close, and not very good. However, down here we do see the indicator going up, which means some of the market participants are going into the industrials and the stocks that have not been performing well this year, and out of the tech and semiconductors. But I'll tell you what, the tech and semiconductors, if you watch our ETF video, you'll see the tech and semiconductors, even though their indicators are pointing down, the stocks that we've picked out of those ETFs, in other words, the better than average stocks. We take the ETF, we look at all the stocks in that ETF, and we pick the ones that are the strongest, in other words, the above average stocks, and discard the below average stocks. So our ETF portfolios are made up of the best stocks, and almost always outperform the ETF themselves, and pretty much do it all the time over the longer term. In other words, you pick the top stocks in an index, an ETF or a mutual fund, and you're going to outperform that mutual fund. So that's all there is to that theory, and it works very, very well, and all our research and actual portfolios show that. So therefore, we are looking at the ETFs themselves are starting to turn down, but our top stocks have turned down just a little and still doing very well, with one of them in the 30 percentile and another one up about 28 or 29%, which is more than doubling the S&P 500. So folks, it's best to pick the best stocks. It's that simple. And when we look at portfolio protection for those puts that are 15 or 20% out of the money, we are protected. This is about a $140,000 portfolio. We protect it with 3 SPY puts so that we keep rolling over into each month. And you can see down here the SPY 425 we have for July, and the 440s for August, the 475 for September 20th. So as the market climbed up, we raised our insurance, even though still 12 to 15% below the market. But as the market went up, so did our insurance, which is very nice to do, and it's pretty easy to do. Just follow us in our daily letter. So folks, we had well, I don't want to say a fun week this week, but we had a come to reckoning type of market this week, even though it was the last trading day of June going into July. That's usually a bullish scenario. And again, I mentioned that we have the 4th of July holiday coming up this Thursday, which is usually bullish for the market. But it seems as though the bears are starting to overtake even the upward bias times in the market, and we have 2 of those: end of the month, beginning of the new month, because the end of the month, the big portfolios will adjust their portfolios. The beginning of the new month is when the pension money comes in, such as the IRAs and the 401ks, and they are put to work immediately as soon as that money comes in. So that's why that's a strong period, the end of the month, beginning of the next month, plus the bullish bias going into a holiday. And of course, with July 4th on Thursday, everybody's taking a 4-day holiday. They're forgetting about going to work on Friday, and therefore we'll see whether they want to get rid of their stocks on Wednesday and keep them over the 4-day holiday, their 4-day holiday. But we'll see what happens then, folks. But we have a bullish bias, seasonal bias in the market, but we have a bearish market. So those bulls and the bears are fighting it out. But guess what? don't worry about it. Go to the beach, go for a walk, be with your loved ones, have a Sunday dinner. Most of all, stay safe, forget about the market, and we'll see you right back here with our Tuesday Daily Letter.